Point 1. Learning to invest isn't rocket science. It just needs some time and effort. Let's talk about investing. You know that thing where you put your money into something with the hope of getting more money back in the future. It's not as complicated as it sounds, and it's definitely not gambling. That's the main message from Benjamin Graham, the father of value investing, and Jason Zweig, a well known financial journalist. So, what is investing? Well, it's when you, as an individual or a company, put your money into something like stocks, bonds, mutual funds, or real estate, expecting to get a financial return. The whole point is to increase your wealth over time to meet your financial goals, like saving for retirement, paying for education, or just getting richer. Graham and Zweig want to make it clear that investing isn't about taking a wild guess and hoping for the best. It's about making a well thought out decision after doing your homework. When you invest, you're buying an asset or something that you expect will generate income or increase in value over time. Now, it's important to understand the difference between investing and speculating. They might seem similar, but they're not the same thing. When you invest, you're making sure that your original amount of money is safe and that you'll get a decent return. You're not swayed by the ups and downs of the market. Instead, you focus on the real value of what you're investing in and expect to see rewards in the long run. Speculating, on the other hand, is more like gambling. You're betting on short-term changes in the market, hoping to make a quick buck. But this approach doesn't guarantee that your original amount of money is safe or that you'll get a decent return. In fact, you could face high risks and big losses. So, how do you become a smart investor? Graham and Zweig say it's all about education. You need to understand the basics of investing, do your research, and stay disciplined. This means understanding what you're investing in, what the potential risks and returns are, and how it fits into your overall investment strategy. In a nutshell, investing isn't some mysterious activity that only financial wizards can do. It's something that anyone can learn and understand. And by knowing the difference between investing and speculating, you can make smart decisions that will help you grow your wealth and achieve your financial goals. Point 2. Smart investors don't gamble. They research before they invest. Investing isn't a game of who's the smartest or who has the most degrees. It's about having the right mindset, discipline, and a hunger for knowledge. It's about being a savvy investor who makes decisions based on careful research to avoid losses. Let's take the stock market as an example. It's a marketplace where businesses sell pieces of their company to raise funds. As an investor, you can buy these pieces or shares and become a part owner of the company. The worth of your shares will fluctuate based on the company's performance and the overall economic climate. Now picture two investors, Investor A and Investor B. Investor A is a speculator who makes decisions based on market whispers and short-term trends. He buys shares when the market is on a high and sells them when it's on a low. His decisions are driven by fear and greed, not by logical analysis. On the flip side, Investor B is a savvy investor. Before buying shares, he examines the company's financial health, its competitive standing, and its future prospects. He doesn't get swayed by market whispers or short-term trends. Instead, he focuses on the long-term potential of the company. He buys shares when they are undervalued and holds on to them until they reach their true worth. His decisions are driven by research and analysis, not by emotions. In the long haul, Investor B is likely to earn higher returns than Investor A. This is because he makes decisions based on facts, not on emotions. He understands that the stock market is unpredictable in the short term, but in the long term, it mirrors the intrinsic value of companies. By investing in undervalued companies, he is able to buy low and sell high, thereby earning a profit. This is the crux of the advice. Be a savvy investor, not a speculator. Do your homework before investing. Understand the company and its prospects. Don't get swayed by market whispers or short-term trends. Invest for the long haul, not for quick profits. But what if the market crashes or there's a sudden surge in inflation? How should a savvy investor react? The advice is that in such situations, the savvy investor should stay cool and stick to his investment strategy. He should not panic and sell his shares. Instead, he should see this as an opportunity to buy more shares at a lower price. When the market recovers, these shares will rise in value, thereby earning him a profit. In conclusion, being a savvy investor is about making informed decisions based on research and analysis. It's about having the discipline to stick to your investment strategy, even in the face of market volatility. It's about investing for the long haul, not for quick profits. By following these principles, you can avoid losses and earn a steady return on your investments. To stay ahead, smart investors predict market trends, not just follow them. Let's talk about smart investing. It's not about chasing the latest stock trend or getting swept up in market hype. It's about making calculated decisions based on a deep understanding of a company's worth. Think of it like a seasoned sailor navigating stormy seas. They don't just go where the wind blows. They use their knowledge of the sea and their navigational skills. Take bonds, for example. A bond is like a loan you give to a company or government. In return, you get regular interest payments. It's a pretty stable way to invest, but it's not without its risks. If you're only looking at the potential profit from interest payments, you might miss the risk of the borrower not paying back their loan. A smart investor would consider this risk when deciding to invest in bonds. Then there's the case of initial public offerings, or IPOs. This is when a company first sells its shares to the public. A lot of people get excited about IPOs, hoping to make a quick buck. But this is a risky game and doesn't guarantee you'll make money. A smart investor would take the time to really understand the company's fundamentals and future prospects before deciding to invest in its IPO. Smart investors also know the value of diversification. This means spreading your investments across different assets to reduce risk. It's like not putting all your eggs in one basket. But diversification isn't just about investing in foreign stocks without considering the risks, like changes in currency value and political instability. A smart investor would weigh these risks against the potential benefits before making a decision. To drive this point home, let's look at the tulip mania in the Dutch Republic in the 17th century. This was one of the first recorded speculative bubbles. Prices for tulip bulbs went through the roof and then crashed, leaving many investors with big losses. A smart investor would have seen the signs of a bubble and steered clear of investing in tulip bulbs at inflated prices. In a nutshell, smart investing isn't about following the crowd or making decisions based on emotions or short-term trends. It's about making informed decisions based on careful analysis and a long-term perspective. This approach might not always lead to quick profits, but it's more likely to result in steady, long-term financial growth. Point 4. Becoming an investor isn't a cakewalk. It needs practice and a lot of homework. Investing isn't something you can master overnight. It's a strategic game that requires a good deal of research and practice. It's not about picking a stock and crossing your fingers. It's about understanding the ins and outs of the company you're investing in, its financial health, its management, and its future prospects. Let's break it down. Firstly, investing isn't a roll of the dice. It's about understanding the company you're putting your money into. You need to know what the company's long-term goals are. Are they planning to expand, or are they focusing on strengthening their current position? These questions can give you a glimpse into the company's potential for growth. Next, you need to look at the company's management. If the management team is more interested in lining their own pockets than growing the company, that's a red flag. For instance, if they're focused on paying themselves hefty salaries and bonuses, they might not be prioritizing the company's growth and profitability. The company's financial strength is another key factor. A company with a strong financial position is more likely to weather economic storms and come out on top. You can gauge a company's financial strength by looking at its balance sheet, income statement, and cash flow statement. These documents can give you an idea of the company's profitability, its debt levels, and its ability to generate cash. Don't forget about the company's dividend history. A company that consistently pays dividends is likely to be financially stable. Plus, dividends can provide a steady stream of income, which can be especially helpful during market downturns. There are also some specific criteria to consider when choosing a company to invest in. For instance, it's best to steer clear of companies with a total market value of less than $2 billion. It's also a good idea to invest in companies whose current assets are twice their current liabilities, which indicates financial stability. Additionally, look for companies that have consistently paid dividends for at least 20 years and have seen a minimum increase of at least one-third in per-share earnings in the past 10 years. In a nutshell, becoming a successful investor isn't about making snap decisions based on gut feelings. It's about understanding the companies you're investing in, assessing their financial health and future prospects, and making informed decisions. By following these principles, anyone can become a successful investor. Point 5. A daring investor is a smart investor who isn't afraid to take calculated risks. In the world of investing, there are two types of investors: the defensive and the enterprising. Let's focus on the latter, the enterprising investor. This type of investor is not just smart, but also bold and willing to take on risks. So, what does it mean to be an intelligent investor? It's not just about throwing money into stocks or bonds. It's about understanding the risks and potential returns. It's about being well-informed, making decisions based on careful research, and sticking to a disciplined approach. It's about keeping emotions in check and understanding that investing is a marathon, not a sprint. Now let's add a dash of enterprising to this mix. An enterprising investor is not just smart, but also active and willing to take calculated risks. They don't just follow the crowd or stick to safe bets. They're willing to step off the beaten path, explore new investment opportunities, and take on higher risks for the chance of higher returns. For example, an enterprising investor might put money into a startup with a unique business model and high growth potential, even if it doesn't have a proven track record or stable earnings yet. This is a risk, but it's a calculated one. The investor has done their homework, understands the business, and believes in its potential. An enterprising investor also keeps a close eye on their investments. They don't just buy and forget. They monitor their investments, regularly review their portfolio, and make necessary adjustments based on market conditions and changes in their investments. Let's say a company they've invested in starts showing signs of financial trouble, like declining earnings or increasing debt. The enterprising investor won't just sit back and hope for the best. They'll analyze the situation, assess the potential impact on their investment, and decide whether to sell, hold, or even buy more. Moreover, the enterprising investor is open to exploring different types of investments, like convertible bonds. These are bonds that can be converted into a set number of the company's shares at certain times. This gives the investor the chance to benefit from a rise in the company's stock price while still getting regular interest payments from the bond. This kind of investment requires a higher level of understanding and risk tolerance, which is typical of an enterprising investor. In a nutshell, being an enterprising investor is about being smart, active, and willing to take calculated risks. It's about actively managing your investments, constantly learning and adapting, and being open to new investment opportunities. It's not an easy path, but for those who are willing to put in the effort and take on the risks, it can be a rewarding one. Point 6. Smart investors know how to pick the best from a sea of investment options. Imagine you're at a bustling market, teeming with hundreds of stalls selling all sorts of goods. Some stalls are flashy, with loud vendors and eye-catching displays, while others are more subdued, quietly offering their wares. As a shopper, you're faced with a sea of choices. But the smart shopper, much like the savvy investor, doesn't just go for the flashiest stall. They take their time, carefully weighing each option, considering factors like price, quality, and bang for their buck, before making a purchase. Now, let's apply this to the world of investing. There are countless companies out there to invest in, each with its own set of pros and cons. Some companies may have a strong brand presence or a charismatic CEO that draws investors in. Others may be hailed as the next big thing by the media or the public. But the savvy investor doesn't get swayed by these surface-level factors. They dig deeper, scrutinizing the company's financial health, growth prospects, and the true value of its stocks. For example, a company might be making headlines for its innovative products, but a closer look at its financial statements might reveal high levels of debt or inconsistent revenue growth. On the flip side, A lesser-known company might be steadily growing its profits year after year, even if it doesn't make the news. The savvy investor would likely choose the latter, as it offers better value for their investment. The authors also warn against blindly following market trends or analyst recommendations. Just because a stock is popular doesn't mean it's a good investment. Similarly, analysts can make mistakes or have biases. The savvy investor does their own homework and forms their own opinions. They also stress the importance of patience and long-term thinking. Investing isn't about making a quick buck, it's about growing your wealth over time. This means investing in companies that have solid fundamentals and can deliver consistent returns, rather than chasing after the latest hot stock. In conclusion, being a savvy investor is about making informed, rational decisions. It's about looking beyond the hype and focusing on the underlying value. It's about being patient and thinking long term. And most importantly, it's about constantly learning and improving, because the world of investing is always changing. Point 7. Conclusion. Investing is not a gamble, but a calculated risk that requires a deep understanding of the market and its trends. The intelligent investor is not swayed by market fluctuations, but uses them as opportunities to buy low and sell high. It's essential to diversify your portfolio and not put all your eggs in one basket. Value investing is about finding and buying stocks that are undervalued by the market. It's about patience and discipline, waiting for the right opportunity to buy and not being influenced by the market's ups and downs. Remember, the market is there to serve you, not to guide you. Don't let fear or greed drive your decisions. Instead, base your decisions on thorough analysis and sound principles. Investing is a long-term commitment. It's not about making quick money, but about building wealth over time. It's about financial security and independence. Finally, always keep learning. The more you know, the better your decisions will be. Stay informed, stay disciplined, and stay patient. That's the key to successful investing. In the end, it's not about how much money you make, but how much you keep, how hard it works for you, and how many generations you keep it for.